Okay, so this chapter is about how to make budgets for a firm. And the name is very weird, right? It's called master budget. And I will explain what does the master budget mean. So before we start, I just want to, generate some discussion in this classroom. So how many of you have, some kind of financial plans for yourself? Like you plan your expenditures, your income. I think most of us do, right? So if you make this kind of financial plan, how do you do it? So I want some people to share your experience of how you manage your personal income or expenditures. Yes, Nikki?
I have an Excel sheet, so I put bills and stuff, and then miscellaneous, or stuff like that.
Oh, that's really good. I tried to create my own spreadsheet to organize myself, but every time I fail. But now I found that actually there are some apps, right, to help you organize your personal finance. But I'm kind of doubtful about that, because what if they steal your information, right? So they know how much you spend every month, but what can we do, right? The privacy is gone already in this digital world. So if you make your own financial plan, then you won't feel too unfamiliar with the topic today, because here we're just talking about how you make a budget for a firm, right, instead of your personal budget. So in this chapter, we are going to introduce the concepts of the budget for firms, right, and also we are going to discuss how human behaviors will impact on the budgeting procedures. And most importantly, we are going to learn how to make this budget through Excel projects. And hopefully today we are going to cover the first two learning objectives so that I can have a weekend to prepare the Excel project. Okay, first, what is a budget, right? So the budget is defined as a quantitative financial plan for the future business. Actually, the budget, it can also be qualitative, but here we emphasize on the quantitative. So what does the quantitative mean? It means that you need to have a specific number, right, for your future plan. For example, I want to achieve 1 million revenue in 2020, right? So that's a quantitative financial plan, right? You need to have a specific number to describe your future plan, your business plan, right? So here we emphasize the quantitative aspect of the budget. And so as a person, right, we use our personal budget to foresee what will happen in the future so that we can better organize our cash or income, right? How we are going to allocate the resources to different activities. And this is the same for the firms, right? So if the firm has a budget or a plan for the future, then the managers will use it to coordinate their activities to achieve this plan or budget, right? So this is an overview of what is a budget for a firm, right? About the budgeting process, generally speaking, so when the firm starts to budget, let's say for the next year, right? So basically they start with this strategy development, right? So for example, let's say Apple Incorporation, right? So they want to make a budget for 2020. So they, I'm just imagining, right? It's not what they really do. I'm just using the example, right? So let's say they start to develop this strategy of achieving some market share of, let's say, 50% in the United States, right? So that could be a strategy. So it's very, the strategy is very large, or it's an overall business goal, right? So there's no details inside. You just say that, okay, we want to achieve this level of market share, right? So that's a strategy. But to achieve that strategy, we need to have some detailed plans to help us achieve that goal, right? So we need to make the plans which are more detailed or more specific to achieve the strategy that we developed. And after we have all those goals and strategies, plans, we need to carry them out, right? So you have the actions. So for example, after the strategy of achieving 50% of market share is developed, right? So the plan could be, okay, let's rent more factories or retail stores, right, in the United States and hire more people so that we can sell more phones to the customers. And after that's been done, then the firm should actually, pay for the rent and hire more people, right, to take action. So after the actions are carried out, we will receive the feedback maybe in 1 month or 2 months, right? So at that time, the managers can compare the actual performance, right, after the actions are carried out with the planned performance, right? The planned performance is usually listed on your budget, right? So for example, our strategy is to achieve 50% of the market share. So at this moment, you can compare your actual market share with the 50% and see whether you achieve that goal, right? If not, then you need to figure out what's going on and take corrective actions, right? So if you achieve the goal, then everything's fine. So sometimes after you compare your actual performance with the planned performance, you may change your strategy and start this loop all over again, right? For example, let's say, the actual market share that we achieve is actually 30%, which is 20% short of the 50% goal, right? So maybe the managers say, okay, that goal is just too unrealistic for us to achieve. So they say, okay, let's lower this bar as 40%, right? So we start all over again. So this is just a very simplified explanation of this budgeting process, but this is very intuitive, right? So you first have a plan, have a strategy, then you have plans, and you carry them out, and then you compare what's actually happened versus what you expect to happen, right? And then take corrective actions. So this is a clicker question to test what we just talked about. Hold on. Yeah.
What's the channel?
41. But the answer is already there. How many? Can I It's fine. It's free credits for you. Oh, okay. Let me do something. that's just the 4 elements of this rule. So about the detailed budgeting procedures, actually it varies from company to company, right? So this is very intuitive because every company may have different policies about how to make budgets. Generally speaking, larger firms may have more complicated procedures and also longer procedures compared to smaller firms to prepare the budget. Because if you have larger firms, right, you need to collect more data to prepare this budget, and there are more coordinations involved in the process. And usually we start to make the budget several months before the planned fiscal period, right? So let's say now we are at 2019 April, right? So at this moment we may prepare the budget for 2020, right? So we always look ahead, right? So we start to prepare several months before the actual fiscal period of interest. So that's very intuitive. This is also very, general concepts about the benefits of the budgeting. So remember that loop, right? So we said that the managers start to make strategy and then plans and blah, 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 blah. So that's actually one benefit of the budgeting process because it just helps the manager to plan ahead so that they can weigh the advantages and disadvantages of some decisions, right? So people say that it can facilitate the decision-making procedures through the planning, and also the plan is not it's not static, right? So it means that we change the plan from time to time based on the condition. So for this section, right, we're just talking about some concepts, right? So it's very intuitive, and I don't want to spend more time on that. So if you don't understand, just stop me. And then another benefit is to help the managers coordinate and communicate with the different departments. So the idea is that, let's say we have a plan, right, to achieve, let's say 1 million revenue next year. So how to achieve that? We may, so the sales department should hire, better skilled sales workers, right? And also the R&D department, right? The research and development department should design better products, right? And also the call center, right, should provide better services. So to achieve the revenue goal, actually all the related departments should work together, right, to achieve that goal, to provide better products, better service, and you name it, right, so that the goal can be achieved. So this is what the coordination and communication means, right? So it's not just one department's responsibility, right? It's everyone. It's everyone's responsibility. So here we emphasize the coordination and communication in this big firm, right? So all the related managers should work together to achieve the goal, to achieve this single, unified, and comprehensive plan or goal. And another benefit of this budgeting is called benchmarking. So this is basically what I talked about when I say that we compare the actual performance with the expected performance, right? So that is actually is called the benchmarking, right? So if we have a plan, right, we say we want to achieve 1 million revenue, right? And then we compare the actual revenue that is achieved with this plan and to see whether we achieve that threshold, right? So that is called the benchmarking. And this is one of the most important benefits of the budgeting, so that we know how to evaluate the performance of the firm. Right? So that's the three categories of the benefits for the budgeting. So let's practice this clicker question, right? So a firm expects which of these benefits when they use the budgeting. Oh, I touched it somehow. But yeah, all of them are correct. So first one, right? The benchmark to compare the actual performance and the achieved the planned performance. So this is the benchmarking benefit. And B, helping managers to avoid potential problems before they occur. Yes, because this is related to the planning benefit, right? So if you plan ahead, then you can foresee what may happen and then make better decisions, right? So that's what B is talking about. And C, motivate the employees to achieve sales growth and cost reduction goals. So this is about, I think this is also about the benchmarking, right? So if you have a plan for the future, right, let's say to achieve this 1 million revenue, then actually you are motivating your employees to achieve that sales amount as well, right? And they know where to go, right? They know what to fight for, right? So that's about C. So all of them are the benefits of the budgeting. I think this is very intuitive, right? So actually everybody got it correct. Then this one is about the benchmark itself. So please choose one description that describes this benchmarking the best. So yeah, C is the correct choice. But could you please go through A, B, C, D, so that we know why we choose C? Yeah.
Why it's not D?
Yeah, why it's not D, Wellington?
Because like benchmarking, I don't know, but it's like D, it's trying to like be like for the future, I guess. Right,
Like a plan
benchmarking is
for the
kind of like
future.
figuring out like what happened like before.
Yeah. Yeah. Okay. So here the benchmarking is actually to compare. Right? So the essence is that you compare your achieved results with your expected results, right? So, but number D is to say outline the future action. So the D is more about the planning aspect of the budgeting. So C. But why C, right? So as we said, the benchmark is to compare the achieved performance and the expected performance so that we can use it to evaluate the performance of the firm or the managers, right? So that's why C is correct. Yes?
I think someone asked about B too, because I put B only because I know C says to evaluate, but if you're gonna evaluate, don't you need cooperation between accountants and operational personnel to actually evaluate the performance?
I think that link is too far away. So here the budgeting requires cooperation and coordination. I think that itself is, I think, how did you create that connection between B and
Well, because in order to evaluate something,
Mhm.
two groups or groups need to come together to discuss and evaluate performance. So if you're part of the accounting and you're part of the operational, you want to go over the numbers to evaluate the numbers to develop a plan.
Okay,
So-
if that's the case, yeah, but I think here, let's just think it intuitively, right? So, okay. Yeah, but I think here, if you just concentrate on the the comparison, so that we evaluate the connection between the corporation and benchmarking is actually is very weak. I mean, it can happen, but let's just think very simply about this question. So just don't get bothered by that. Okay, so here, next we're going to talk about some philosophies of how to make the budget. Right? So the first method is to use a way called the top-down method. So the top-down method says that basically the one budget for the whole firm is made by basically one person. Usually this person could be the senior manager of this firm, right? So basically the top-down method says that the senior management or manager will develop this high-level or holistic budget for the whole firm. For example, let's say we are a firm, right, and I am the senior manager, so basically I plan everything for our class, right? So that's a top-down method, right? Everything is from the senior manager, and she or he allocates the budget to the underlying departments or employees, right? So that's the top-down. So now let's discuss some pros and cons of this top-down method. So what advantages can you think of in this kind of top-down method of making budget? Right, so let's say you guys are all the managers in different departments. Right, for example, Gio is in sales, Rainier is in production, David is in R&D, something like that, right? And I'm the CEO or CFO, right? So I make the budget for the whole firm. Basically, I say, okay, the R&D, you only have $10,000 next year to develop your products, right? And also sales department, I require you to achieve 1 million revenue next year, right? So what kind of advantages or disadvantages can you think of for this kind of top-down method? Yes.
I don't know. I'm thinking this is like well, the thing is when the top person is telling you exactly what to do, they're not within your department, so they don't know what's best for your department.
Yeah.
So it's kind of like the opinion is not supported properly because you don't know what's going on within the department.
Yeah.
Because you're up.
Yeah, that's a very good point, right? So what Abigail is saying is that, let's say I'm the top manager, right? I just require the lower level managers to achieve certain goals that I think is achievable, right? But here we have some information asymmetry. Let's say I think Gio can achieve 1 million revenue next year, but I'm not the sales manager, right? So I may not know the details of how things are going on, but he may know what's going on, and he knows how achievable this 1 million is, right? So maybe he thinks, oh, she's just giving me a tough time, right? That's not possible to achieve 1 million, right? So that's one disadvantage of this top-down, right? So because of this information asymmetry, right? So it could make the budget less achievable because of information asymmetry or less accurate, right? For example, Gio knows better about the sales condition. So in his mind, he may think, oh, 8 million is actually achievable, right? So that's a more accurate number. But I don't know the situation, so I just made up some number. Could be, right? So that's the disadvantage. So what about the advantages? David?
I guess to go along with that, you could also say that, you know, if you have all the departments coming up with their ideas, you know, they're going to be selfish and they would want to
yes.
work for their
Right,
department.
right.
So the advantage of
Right.
a single person is they get the overview
Right.
and they can manage.
Yeah, so David is touching the other side of the information asymmetry, right? So let's say still using sales department that Gio runs, right? So maybe Gio can lie to me, right? If we do not use this top down, right? So David says, okay, if a single person who can control the whole situation, you know, maybe we can avoid this kind of lying, like misreporting, something like that. Right, so that's kind of advantage of this top-down, right? And other advantages I listed here is that because the budgets are made by myself, so it means that I do not need to, you know, asking all of you to coordinate with each other, talk to each other, and give me a number, right? So we save a lot of energy of coming up with the budget, right? So we will have less cooperation, coordination, so it's less time consuming, right? Because everything is just made by myself. I just sit on my desk and come up with the budget, something like that. So this is about the top down, right? So the basic idea is that a single person or a single department is responsible for making the budget for the whole firm. So this is the top down. And in contrast, we have this bottom up method. So this is totally different from the top down, right? So the bottom up is saying that the lower level managers or the individual departments, you come up with your budget, right, and give it to me, who is the senior manager, and I integrate the numbers from different individual departments, right? For example, Gio told me, hey, our sales department think that next year, 5 million, right, as the sales revenue. And Rainier came to me say, hey, we are going to spend like 10,000 as the expenditure for the R&D, right? And then David told me we are going to use 15 million to do something, right? So everyone come to me, and then I integrate the number, right? So that's called the bottom up, right? So for the bottom up, as you can see, right, I need a lot of coordination among you guys, right, to come up with the budget for your department, right? And I need to integrate all the numbers, so it's very time consuming. But the advantage could be, as Amethyst mentioned, right, because every department may know better about their situation, so they may come up with more accurate and more achievable numbers, right?
Professor?
I think, I put it wrong. Right? So this one is the advantage, that one. Or, yeah, question?
Yeah, so you said that when they get the information, they integrate it. So are they trying to get one number for every department to reach? Like it's a number that every department has to meet? So is that what they're,
What do you mean,
like when the, whoever's on top,
yeah.
when they are trying to get the information from the departments,
Yes.
the number
Yes.
that they can reach, is it one number for every department? Or
It
is
depends, but the basic idea is that when we use the bottom up, right, there should be a higher level department or person who collects all the data from different departments so that a single budget can be made for the whole firm, right? So in this way, it's not a single person who made the decisions. It's him who collects the data from different departments and integrate them. So this is in contrast to the top-down method. Okay, so you see the bottom-up is the individual departments come up with their budgets and be integrated as the whole budget, right? Versus the top-down says, okay, a single person makes the whole budget directly. So that's the top-down and bottom-up, right? And we also have a method called incremental. So what this budgeting method means is that, let's say we already made the budget for 2019, right? So we are going to just use 2019 budget. We continue to use this in our 2020. So this is the incremental, right? So basically we just depend on our previous budget and use it in the future. Or we can make some tiny little adjustment based on the previous budget. Yeah.
Is that the most common budget?
Actually, I'm not sure. I think it depends on the type of the firm and also their own beliefs about how to make a good budget. But this incremental budgeting method actually relies on the assumption that the past is similar to the future, right? That's why you can use past years' budgets in the future. So in this way, right, we can think that it's not suitable for industries that have very volatile market conditions. For example, the IT industry, right? So it's usually the case that this year could be very different from next year, right? So for this kind of highly volatile industry, the incremental budgeting method might not be applied. But for some very stable industry, for example, food manufacturing industry, right? So for this kind of industry, maybe they are using the incremental method. So the advantage of this incremental budgeting method is that it's very, it's less time consuming because we just rely on the previous year budget for performance, right? So it means that we do not need to spend a lot of time figuring out what could be the budget in the next period, right? So because everything is already there. So it's less time consuming. But as I said, it relies on the assumption that past is equal to the future, right? Which is not valid in some situations, right? So this is the incremental. And in contrast to incremental, we have the method called zero-based. So the zero-based basically says that we start every year as new, right? We start from zero each time we make the budget. So in this case, it means that we do not have a example that we can use, right? Compared to the incremental one. So for the zero-based, it's more time consuming, right? Because you need to come up with the budget numbers for every item. And by the way, I think I put the wrong arrows here, right? So the time consuming is the disadvantage, so you should go to the right-hand side. But the advantage of the zero-based is that since every time we consider the situation as new, so we may come up with more accurate and more relevant budget for the new term. Right, so now you know the four philosophies, right? The top-down versus bottom-up, and incremental versus zero-based. And you should understand some advantages and disadvantages for each philosophy, right? Intuitively. So that's about the budgeting philosophies. So let's look at this clicker question, right? So which one is true about the bottom-up? Questions, I think you noticed that some of the clicker questions appeared in the exam, right? And for the final exam, it's still going to be the case, right? So some of the clicker questions might appear in the exam. So you need to pay special attention and make notes for the clicker questions that you made mistake on, right? Yeah. So okay. For A, I think for people who chose A, you just read the first part of the sentence and you didn't finish. Why? Because let's see, the budgets are developed separately in a company's business segments. Yes. So coordination is not necessary. Is it necessary? Yes, because as we just mentioned, right? So if we collect the budgets from different departments, we need to integrate them so that we can come up with a comprehensive budget for the whole firm. Right, so A is not correct because of the last part, right? The first part is okay.
Yeah,
The second part is not. Right? Okay. And B, yeah, that's correct because the bottom up lets the individual departments to make their own decision about the budget. So it's generally more achievable, right? It's not why you set your own goal like that, right? And number C, it's quick. It's not quick, right, compared to the top-down, because we need a lot of coordination there, so it's not quick. And D, preliminary budgets are developed by top managers. This from the very first part, it's wrong, right, because it's not by the top management, it's by individual departments, right? So D is not correct. So the correct answer is the second one. Okay. This part, in this part, we're going to talk about how human behaviors will impact on the budgeting process. So we're going to talk about two interesting budgetary games, right? So the reason why we call them games is because of the human interaction inside. So the first budgetary game is called the budgetary slap. So what does that mean? It's actually very close to what David mentioned, right? So let's say I am a very, selfish manager, right? And David is my senior manager. He asked me to come up with a revenue plan or a profit plan for the next year, right? And if I do not have highly, moral standard for myself, what I could do, right? I could say that, we can only achieve 1,000 revenue, right? I can set my goal really low, right? So I have the intention or incentive to understate the planned revenue, right? So the reasoning behind this is to make myself more likely to reach my goal, to reach this budget, right? Or I may overstate the planned expenditure, right? So sometimes, in firms, we have this expenditure control, right? So basically, we want to spend less, right? So if I overstate the planned expenditure, it's less likely that I will hit that bar, right? So I will be evaluated as performing well. So that's the idea behind this budgetary slap. So the managers may intentionally understate the planned revenue or overstate the planned expenditure so that the chance of beating this budget or the chance of achieving this goal can be increased, right? So let's say normally, right, we make 1 million as revenue, and suddenly you say, okay, let's make the budget of the revenue or the goal of the revenue at 0.9 million, right? So that the goal, the bar of the goal is lower, right? So I can cross it easily. So that's the intuition behind the budgetary snap. So is this understandable, the budgetary snap? Yes. So the other budgetary game is called spend it or lose it. So let's say David, he allocates me, let's say 10,000 as the expenditure to use, right? So it means that I have the quota of the 10,000 to spend on my, let's say, R&D, something like that, right? So at the end of this fiscal period, I found that, I only used, how much did you give me? 10,000? Okay, let's say I used 9,000, right? So it means that I still have 1,000 quota left, or by budget, right? So I have the budget of 10,000, and I actually used 9,000, right? So I still can use 1,000. So my incentive is to use the 1,000 anyway. So the reason behind this is that if we do not spend the 1,000, right? So when we do the benchmarking, right? David will find out, actually 10,000 as the expenditure budget is too much. Actually, she only can use 9,000. So next year we cut it to 9,000, right? So if I know that if I don't spend all of the 10,000, my budget next year will be lower, I don't want to lose that part, right? So I will spend as much as I can so that I can keep the budget next year. So this is called the spend it or lose it game, right? Either you spend it or you lose it in the future, right? So this is the this budgetary game, right? So so the managers, they have this incentive to spend more than the actual need to prevent the decrease of next period's budget, right? So to understand, you just need to think of the example that I just gave you, right? So I was allocated 10,000 to spend, right? But I actually can only spend 9,000. However, I have the incentive to consume the rest of the 1,000 so that I can keep the 10,000 budget in the future, right? So this is the spend it or lose it budgetary game. So let's look at this true or false choice question. So it's about the budgetary step. Oh, sorry, I will reopen it. Okay, you do. But you already see the answer. Okay, who can explain why this is false?
Should be reversed.
Yes, Winston?
It's the opposite.
Yeah, it's the opposite, right?
It's when you understate revenues and overstate expenses.
Right, so here should be the, I'm until you missed this question, so you should email me. So here we are going to talk about some types of budgets. So the first type of budget is called the strategic budget. So as we mentioned, right, a strategy is usually less detailed and it's an overall goal. So it's usually, so when we make the strategic budget, it's usually long term. So by long term, we mean more than 1 year. And as I said, it's less detailed, right? So it's a long-term budget for your future. In comparison, we have this operational budget, which is short-term. So it's usually 1 year or less, right? So in this class, we are going to talk, the master budgets that we are going to talk about is actually the operational budgets, because we are going to look at basically 1 year, within 1 year or a quarter, right? So here in this class, we focus on the operational budgets, which are short-term budgets, and they are more detailed compared to the strategic budgets, right? So this is the first pair of the budgets, right? We have the strategic and the operational. And we also have the other pair, which are static budgets and flexible budgets. So static budget, so why do we call it static, right? It's because in this budget, we only use so we only consider one situation. And as we will discuss next time, it's actually based on one level of sales amount, right? So that is called static. But the basic idea is that we only consider one situation. So that's called static. Whereas the flexible budgets consider various conditions, right? So in a sense, we are going to use multiple levels of sales amount to develop this flexible budget, right? So in one word, static budget, in static budget, we are going to foresee, okay, next year we are going to make 1 million revenue, something like that. But flexible budget tells you we may make 1 million, we may make 2 million or 3 million, right? So static budget only gives you one option for the future, but the flexible budget gives you multiple options for the future. So this is the difference between static and flexible. Okay, so what about this clicker question? A firm's 5-year budget. Abdullah, do you have a question?
No,
It's about the static and flexible. So this is the strategic budget, right? It's long term. And okay, about this. Right, the kind of budget that's that can provide, okay, that's for different levels of sales volume or different levels of data, right? So you can think of the example that I just gave you. Okay, 2 more clicks. Make sure that you click. So here, this is the flexible budget, right? The flexible means that it gives you multiple choices, right? Multiple options for the future. Okay, this one I will skip. So this is okay. We still have 5 minutes, so I will talk about the master budgets real quick, so that we can start from this part next time. So the master budgets, right? So what does master mean? Does it mean expert? No, right here. Or does it mean your master degree? No, right? So here the master means main, right? The main budget. Right? So that's what the master means here. So what is the master budget? It's basically a collection of all the lower level budgets, right? So that's why we call it a master budget. So what are those lower level budgets? Okay, we basically have 3 collections of the budgets. So we have the operating budgets, the capital expenditure budget, and financial budget. So you may take a note. But next time we're going to talk about this diagram, right? So the diagram labeled with different colors are different collections, right? So the operating budgets are basically the budgets related to our operating activities. For example, the sales, the production, right? And after we know the production, we can make budget for our manufacturing costs, which are direct material, direct labor, overhead, and also we can make the cost of goods sold budget. And in the end, sales and administrative, right? So all those activities related to operating, we can make a budget, and those are called the operating budget. And capital expenditure budget will not be covered in this chapter, but the capital expenditure basically means your purchase of some assets that can be used in the long term, right? And we have financial budgets. Basically, it's just about the budgets that you make for your financial statement. We have the income statement, balance sheet, cash flow, and we are going to talk about the cash budget.